Hello, everybody. This is Russell Gray, co-host of the Real Estate Guys radio show, here for another edition of Boots on the Ground. And we're going to be talking about Jacksonville, Florida, and build to rent homes, rental homes. Obviously, build to rent. You're going to build them and rent them. And in a world where they say there's not enough inventory, there are certain markets that are really the beneficiaries of the great migration that's being caused by some of the hardships in the economy. So while some markets are losers, and they're losing population. Other markets are winners, and Florida has been on everybody's hot list of places to go, both businesses and individuals. And of course, you've got the baby boomers who are busy retiring, and Florida has always been a hotspot retirement destination. So for a lot of different reasons, Florida continues to be one of our favorite markets. And so joining me today are our good friends from Southern Impression Homes, uh, Chris Funk and his partner, Jim Sheils. Hey, guys.
Hey, how are you, sir? Good to see
Good.
you.
Excited to have you back. Chris, let's start with you because you've done these things with me many times. And just for the folks who don't know you and Southern Impression Homes, just give us a very short nickel tour about your background, your history in that market, and what your company does. And then we'll introduce Jim.
Absolutely. So, Southern Impression Homes is a build-to-rent company. We build primarily in Florida. We do a little work in Georgia as well. But Jacksonville, Palm Coast, Ocala, Citrus Springs, Inverness, Port Charlotte, Punta Gorda, Cape Coral, Fort Myers, just name a spot in Florida, and we're probably building there. We build a combination of product between townhomes, single-family homes, duplexes, and quadruplex product in all of our markets. And we're focused only on investors. We do not sell homes to retail home buyers at all. This is our main focus is servicing Main Street investors looking to add real estate exposure to their portfolio.
Yeah, so we are big fans of build to rent. If you follow the show or have followed the market cycles for quite some time, you know that coming out of the great financial crisis, there was gobs of existing inventory, and nobody could afford to build new homes because the existing homes were so much cheaper than replacement costs. And so that was a great time to be a buyer of existing product. After a while, all that product got absorbed, and pretty soon we had a shortage of product. It drove up prices, and then people were having a hard time buying. And so builders came out and they began building. But a funny thing happened. It seemed like there was a greater demand for investment product than owner occupied product. And John Burns at John Burns Consulting said, hey, the sector to watch is build to rent. So we started watching that. And along the way, we met Chris and company at Southern Impression Homes. Not only do they do build to rent, but they do it on a pretty big scale. So, Chris, just take a moment and talk a little bit about how much volume you guys do in all those different markets down there.
Sure. So we'll build right around 1,000 units this year, maybe slightly more than that. We might hit 1,100, and we manage thousands of properties across the state of Florida currently. Part of our value proposition is not only do we build it, but we also manage it post closing to
Of
make
course, this
sure.
part's huge, right? And when you're an out of area landlord, the biggest and most important factor in your decision making is, can I get great property management? And the flaw with buying outside of your area is the person selling it to you really doesn't really care what happens after you buy it. But in your case, you guys do, because you have to live with it right along with the landlord. And property management is a big, big part of your business. Literally thousands of units that you manage. So it's not just like some part-time little gig you do on the side. It is a major standalone business. We've talked to Becky over at Suncoast, and we've certainly had those discussions about what's going on the property management front. But you have made some changes at your company recently as well. So why don't you introduce your new partner, Jim, and tell us how that came about?
Absolutely. Well, Jim has been a partner of mine for many years now, but we really just made it official here the last 6 months. So Jim has been with us in his own entity, which was called Jack's Wealth, and in after we had our merger with Sumitomo Forestry, Jim merged his company in with us as well. So we're now one big happy family. And I say that, but we really just made it official. We've been common law for a long time. Now we just officially got married.
There you go. So, Jim, take a moment and tell everybody a little bit about your role in Southern Impression, and then we're going to get into Chris and Jim talking about the market, what's going on in the specific geographies, and the things that people should be paying attention to, both in the macro with the interest rates and loan programs. I know you've done some creative things there, and then also what's happening, in terms of migration patterns and absorption and rents and all the things that real estate investors care about. But Jim, talk a little bit about your role with Southern Impression Homes.
Yeah, my key role for us is really in investor relations and sales. I've been an investor first. That's how Chris and I met 12 years ago, doing the foreclosure game. And almost about 9 years ago, Chris said, "Hey, why don't we build some of our own properties?" So we threw in that for that first development up in Northwest Jacksonville, the development fees, and it went okay. But then we said, gosh, we have something here. And so we kind of have been going back and forth. And that was always my specialty, sales and investor relations, because I just had a large group of investors I was friends with, worked with. So I'm always trying to find out, what is the investor wanting? What do they need? What are they needing less of, more of? And also financing, like Chris said. I was taught years ago, Russ, if you get good cash or good terms, you can make a good deal. And so we're always trying to get great condition in good areas. But if we could solve this financing issue that started to really peek its ugly head last June, we thought we could really help our investors have a kickstart that they couldn't get elsewhere. And that's something we've been working on very diligently for the last 4 months.
Right. Well, we've obviously been experiencing a very different market. Interest rates at the Federal Reserve level spiking faster than they really ever have. All kinds of issues it's created in the banking and lending sector because of the balance sheets getting blown up. Sure, depending on when you're watching this, you've heard about Silicon Valley Bank and then First Republic Bank and now other banks that are teetering. And there seems to be a little bit of a consolidation. Lending guidelines are tightening either directly or indirectly. Of course, we have a big syndication program. We teach people how to raise money. We've always believed that there's a big opportunity, Main Street investing in Main Street and private capital is one of the things that our syndicators love best about Southern Impression Homes is the ability to come in and do volume. You got to turn over a lot of rocks to find one or two or three properties to invest in. If you try and find 10 or 20 or 30 to invest in, it's a heavy lift. But when you can go to one source and one great market, kind of get the whole thing turnkey, it makes being a syndicator a whole lot easier. So Chris, or Jim, but Chris, let's bounce back to you. Let's talk a little bit about what's happening on the ground there. We've covered Jacksonville in the past, but give the high notes of what the market's all about. And I know it's not just Jacksonville. That's kind of the big hub. And there's other, I guess, not even suburbs, but other sub-markets of Florida. But what's going on in Florida in general, as in terms of migration, job creation, cost of living, affordability, wages, all of that. And then what's going on in particular in the major markets where you do the bulk of your business?
Sure. Well, from a demographic level, Florida is just still rapidly growing. We're growing at about 2% a year, which our population's over 20 million. So we're growing over 400,000 people a year. So well over 1,000 people a day are coming into the Florida market. Which again, for us, putting houses on the ground and creating shelter, we want to make sure there's people to fill that shelter. So that's, obviously the biggest factor that we have in Florida right now is that. And of course, the jobs are here in Florida because there's plenty of population. So jobs continue to come. And then, the sheer number of people moving to Florida creates additional jobs on top of it all from, all sectors. So we've got a robust job market and, and obviously, it's a very tight job market. So, we see wages continuing to increase, which again is great for us as a rental company. We want to see our tenants have plenty of cash in their pocket to be able to pay the bills. So, from a demographic standpoint, that's where we are. From a home building standpoint and, just a general construction standpoint, I have to segment that into a couple different markets. For those of you who have listened to me over the last couple of years and heard my tales of woe of not being able to get materials and not being able to get labor and all of the chaos that was going on during COVID, all of the price increases that were happening, we've leveled out from that significantly. We have more trades readily available. I still won't say that they're in abundance. But we're able to staff the projects in order to build homes in reasonable build times. before the pandemic, we were happy, if we were getting a 120, 140-day build time. In the pandemic, it was 12 plus months, or longer. Now we're looking at, 6-month, 7-month build times. So, significant improvement, which, we're very happy about. From a backlog standpoint, we are basically caught up in all of our markets except for Southwest Florida. So today, you can come in and buy a home that the slab is already on the ground, frame is up, and, you can have a pretty definite timeline of when that property is going to close, versus, in the COVID time period, who knew when the permit was even going to come out? That was the question. So huge improvements there. I'd say, our biggest struggle construction wise is probably still our Southwest Florida market. Not only were we still recovering from the supply chain issues of COVID, well, then a hurricane happened to hit the market, which never helps from a construction standpoint. Jim, I'm sure we'll talk here in a minute about, how well we came through the hurricane and how little damage we saw due to the new building codes, that the state has. But it still has created some, construction delays. So we still have a little bit of a backlog there, but it's still a phenomenal market. I mean, people are flowing in there in droves, and, we expect to be dug out of our backlog there in another, 4 or 5 months. So we'll be able to, have a lot more readily available product in those areas as well.
Nice. Anything you want to add to that, Jim?
Yeah, just the hurricanes. We felt really good after the hurricane, which sounds crazy, but we had hundreds of projects going on right in that greater Fort Myers area. And it hit Fort Myers. It also hit Punta Gorda. And Punta Gorda was really interesting. If you remember, in 2004, when Hurricane Charlie hit, it decimated. I had relatives there. It was really sad. And the government, the state government stepped in and said, no more. We're changing how high you got to build. We're changing the strength and the structure. Well, when you looked at Punta Gorda the next day, it was really okay. You thought, oh, there was some wind here. And we saw the same thing. And the reason is new construction. Anything built after 2004 is built at a higher ground and better integrity. And so out of a few hundred projects down there, Russ, we had just four projects that needed insurance claims. And that's because it was just the freestanding walls. We didn't have time to tie the roof on, which really gives it the strength. So those freestanding walls fell over. But with that, we had no flooding either. And as you know, wind is bad, but it's the flooding. So building to these new construction standards, I'll tell you, Chris and I are the first to kind of grovel like, oh, it's so expensive, dragging in all this extra dirt. But I compare it to when your folks said, in high school, wear your seatbelt. And then, yeah. And you get in that first big car accident, you're okay because you had your seatbelt on. You're like, phew, that's how we felt about Hurricane Ian this fall.
Gotcha. Well, I think a lot of people, when you really think about the option of buying new or buying something used, you'd like to get new. And when it comes to buying a property, when you're responsible for the maintenance as a landlord, you obviously want to get something as new as possible and as great a condition as possible. Builder home warranty really controls a lot of those hidden expenses, sometimes the deferred maintenance. Not that a great rehabber can't give you a great property, but it's hard to compete with brand new. And especially when you're talking about building codes that have been upgraded and you've got an environment like you have in Florida, where every once in a while you get some tough weather conditions. So as a landlord and a property owner, it's nice to know that you can buy those types of properties and have a little bit of peace of mind in the early years when you're owning the property and you haven't quite been able to push the rents. And so let's talk a little bit about rents. Obviously, what everybody is most concerned about when they buy a property is the ability to own it long term. If you pick a market that you think has a good long-term prognosis, you pick a product type and a demographic that you're going to serve that you think is going to be good for the next 10, 15, 20 years, then really what you're talking about is the ability to stay in that property and maintain control. And that's going to be a function of what you pay for it, how much financing and expenses you have, and then the rents and the direction you can push those rents. So let's kind of break down those components, starting with, the purchase price. I know that there was a time when lumber was just through the roof and some of that's abated. Energy shot way up and some of that's abated. Chris, you alluded to the labor issue, and that's a little bit abated. Of course, we know interest costs and on your financing is an issue for a lot of folks, although that seems like it's slowing down a little bit. So from a price perspective, kind of give us an idea where we're at, maybe where we were a year ago, and then let's back into the rents and then close up on financing, because you guys have got some pretty exciting creative things you're doing to help people get into properties right now and wait it out until equity can happen.
Yeah, absolutely. So the pricing has really flattened out. We've really kind of hit a plateau for the first time in the last 2.5 years. And I, for one, am thrilled about that. The real estate market needed a breather. We could not see these prices continue to go up the way that they had. And in fact, in some cases we've seen slight pullback in pricing, and really it was more slight pullback in list prices versus actual closing prices. Because as the market started to to unwind with these price, these interest rates going up, builders were still experiencing just massive increases in supply costs. So as a builder, we were continuing to say, well, we used to do a 5% margin and that kept getting eroded. And then we said, well, let's put a 10% margin, contingency on it. Well, that would get eroded. And so we kept having to increase contingency because the inflation just kept wiping out our contingency and our margin. So, so we ended up, having these really inflated contingencies. Well, as the actual material cost started to level, and it's gone down a little bit, but honestly, it hasn't gone down a lot. It's just leveled out. But what it's been able to do, that leveling has enabled us to bring our contingencies back down to realistic numbers. So it's had that kind of calming effect on the market. So I think both from our standpoint, but really more importantly from a retail home builder standpoint, they found what they consider to be the clearing price. There was houses that were built with the absolute, highest amount of lumber, and, builders had to, lumber and everything else for that matter. And, everybody had to say from a builder perspective, you know what, those houses just need to go. We're not going to get the margin that we want. And so, they took low margins and have started moving that inventory off of their balance sheets. And, and they've now found a rhythm, and price, material costs have come down enough where builders are back, building at reasonable margins, and, and they're selling houses at a pretty rapid clip here in the state of Florida. So I feel like, the market has, from that standpoint, leveled itself out. And, we've seen something similar to that from a rental perspective.
Let's stay on the construction
Sure.
cost for just a minute, and then we'll flip over to the rent, because I think that it's easy for people to think, oh, I want to buy a property and have it go up 20, 30, 40, 50% the first year or two that I own it. And that all sounds like a good idea. The challenge is that really isn't sustainable on the back end of a hyperinflation like that. There's typically a crash. I remember Robert and I went into Las Vegas a year after it had gone up 52%. In fact, we went in the year before, and then it went up 50%, which was fantastic. But then a couple of years later, it just crashed because there's sometimes a snapback. So it's kind of gratifying for me to hear you say it's leveled off a little bit, especially when you consider the things that were driving it. Back then you had just hyperinflation in lumber. You had supply chains that were broken, which meant that there was an unavailability of a lot of key components, and those things all got bid up as people were trying to get their projects done. They're paying for the supplies to save the money on the hold, right? If you're carrying a deal for 3, 4, 5 months longer than you should have, to get it moving, you've got to get it finished. You pay a little bit more just to get the product in and get the project built. So I think that, time will tell, but I think that it's probably a good thing that it's kind of gotten back to business as usual, because business as usual in Florida, and your markets in Florida, has actually been really, really good. And when a market overheats like that, it gets a little scary. So now let's go back and take a look at the rent side. What's been happening on the rental side? Are rents stabilizing? Are they pushing? Are they softening? Where are we at?
They are. So, we look at two different things. We look at what is a property turning over and re-renting for compared to the last tenant. So right now, a property that turns over is re-renting for about 9% more than it did with the prior tenant. Okay, so that's great.
Yeah.
Which is, far above par, right? I mean, we're normalized as 2-3% annualized rental growth. But what we're seeing is a flattening of that growth. So we're at the stage before you start to see that 2-3% come back in line, because we are seeing rents flatten out right now, which means that as we get to next year, if we don't start to see some uptick, we're going to have some relatively flat growth. So I expect flat rental, flat rents here, statewide. It's going to vary area by area, but if I'm looking statewide, we're going to see rents, be flat for a little while. And I say a little while, they're going to probably start increasing again at some point this year, and I'll explain why I believe that in a second. But they've been relatively flat here for the last 6 months. We've even had a couple markets where we've had some rent pullback. Where the kind of like you were talking about, the rents really spiked, and then the consumer confidence starts to take effect. And, there's fewer households being started because people are saying, well, you know what, I'm going to live with mom and dad for another year as opposed to going out and renting my first place. So, so we saw, pullback in a couple of our markets. But what we're expecting to start, evening this all back out is we saw the builders, the home builders, pull back really big in September, October, November, December, January of, over the past few months. They really, I mean, like permits were cut in half or more, meaning so many fewer houses were being started than had been being started.
In your markets or just nationally?
In our markets.
In your markets, okay.
In all of our Florida markets, permits were down by about 50%. And so what that means is, those houses are houses that would be coming online in June, July, August of this year, based on current build times. So, while we've been kind of struggling through flat rents here for the last several months, I see that we're going to have limited additional inventory coming online for the next few months, which I think is going to really kind of reignite the rental growth. And, in addition, I think with what we saw happen with the Fed, was it yesterday or today? I can't remember what day it is anymore. I think they're signaling they're going to slow down their rate hikes, and if that happens, you're going to start to see a little bit more consumer confidence. So, we're going to get this little bit of a perfect storm again, kind of like we saw in COVID, where, all of a sudden the supply is down again. And then all the people that were waiting on the sidelines now decide to jump in. And, is that going to happen, in August, September, or is it going to happen early 2024? It's hard for me to say exactly, but that's the couple of big items that I see that could really result in us having that uptick in rents again. I don't expect it to be 20% like it was the last couple of years, but I do expect it to be, more normalized rental growth.
Well, this is why we do boots on the ground, because there's really no way, unless you live in a market and really track what's going on, you really can't have your thumb on the pulse of both sides. And before we leave the discussion of rents, which I think is an important one, when you are giving us your opinion, you've got a data set that's pretty big. If you don't mind sharing, just about how many properties does your property management company manage?
We're at 2,200 right now.
Okay. So this isn't like, oh, well, half the people the rents are going up and I'm managing 2 properties, right? And one goes up, so the data set's pretty good size. And one of the things that we like to do is talk with folks that have a little bit of that kind of perspective. And of course, it's also over multiple markets. And so you have the opportunity to compare one market to the other. And I think, Jim, in the investor relations component, part of the responsibility is to help the investor understand the nuances of specific markets versus their goals, because some markets are going to be a little bit more cash flow, some are going to be a little bit more equity growth, depending. Some are going to cater to a certain demographic versus another type of a demographic. We always say, hey, start first with the macro picture. What's going on? Are you bullish with real estate long term? Yes or no? And then specifically in a geography. And if you look at what happened in 2008, for example, a lot of builders quit building in 2008, and you could tell down the road there was going to be a bubble. There was going to be a lack of inventory. Robert and I were talking about it on the show. Even though people were afraid to buy, and it kept the prices a little subdued, it was really the opportunity to buy because we knew that the shortage was coming. And I think what I just heard Chris say, at least on the macro of your total portfolio, you're seeing a little bit of that. And of course, that impacts both the price of the properties, but also the rents. And of course, the other component then, Jim, is financing. We have an environment where credit is tightening a little bit. Interest rates have risen a little bit. Cash flows are a little bit thinner. And then you have a decision to make. You have to say, well, I'm just going to sit out and hope that the market completely corrects and goes back to where it's easy and convenient. Or I'm going to take a calculated risk betting on all the rest of this intelligence that we have, that the demographic is there, the market is right, and there's this window of opportunity when things have slowed down a little bit. Other people are backing up, but the fundamentals are still strong. I'm going to step in, but I still have to use financing. What are you guys doing to help your investors be able to take a swing at some of these types of properties in today's environment?
Yeah, first thing we always do, Chris and I are always looking at the inventory levels. That was a big lesson for me in 07, 06, 07. I mean, the signs were there. Everyone goes, inventory, it's gone up. And well, pandemic had no inventory. Right now, we're sitting still about 20 to 25% below 2019 levels, which by all people's standards was a normal market. So that makes us feel good. So knowing that, we're like, okay, we know we're at a good inventory level. What's the other big thing people say? And if we had $1 for every time someone said, I wish I had locked in a year ago or a year and a half ago, before that crazy last June where it was a hockey stick. And so this was more Chris to give him the credit. So how can we lock in at rates from last year? And, with some new developments of bringing some in-house financing, and we have to pay pretty substantially for it, but we see it's worth it. We've been able to develop an in-house program that actually gets rates back down to where they would have been in May of last year. Last year they were locking in, I think, about 4.69 is what we had from our standard lenders. Chris was able to develop a lending program with a relationship he had for 4.75. So when we say that, people go,
a non-owner occupied property.
Non-owner occupied, 30-year AM, 10-year fixed. So we wanted to make sure it wasn't anything too short. Our people like to look out 7 to 10 years at least with their property. So we didn't want a 2-year adjustment or anything like that. And we wanted that 30-year AM. So we found a product that is basically getting us back to the numbers of pre this crazy Fed hike. And we feel if we can do that, we're giving the advantage that most people can't, not only for ourselves, but for people that we work with.
Interesting. So, Chris, we talked a little bit off mic, and don't know if you're at liberty to share how you guys did that. It's okay if it's a trade secret and you don't want to throw it out there on YouTube. But it is a variation on a theme. It was actually a common technique for individual borrowers to use. When I was in the mortgage business, we did it all the time. But after Dodd-Frank, we lost that ability, and it's such a shame. But you guys found a way to do it kind of on a bigger basis. So if I backed you into a corner, feel free to say, sorry, Russ, trade secret, can't share it. And that's fine.
No, it's something that, that we're able to do just because of the sheer volume of properties that we build and sell. And it's a builder forward commitment where we're able to go essentially buy chunks of money, so we can go buy several $1 million of money at a time for a rate. So we have to pay essentially a premium to lock money in at this 4.75% rate. We have to lock in a pretty healthy amount of capital at that rate in order to do a trade to get that rate locked in. And so once we do that, and we know that we've got the 4.75 locked, we've got X number of dollars that we're able to then essentially give our clients that rate. And, when it's gone, it's gone. And, then we go and we have to go buy another chunk. And, it's something that, that we found has been very attractive and appealing for our customers. And, it's like part of being part of the real estate guys. It's like being part of Southern Impression Homes. You're part of a group, you're part of a family. We're all trying to help each other figure out how to make everything work in this crazy environment that we're in. I mean, it's a weird environment. And but it's still an environment that there's a lot of opportunity. But figuring out that financing piece is really has been the biggest struggle for our clients. And what we found is, of all of our clients, we're the only one with enough volume that can bring this to the table. And so it's been great, and we have several other different interesting finance options that we've dug up as well. I mean, that's really become a focus of ours over the last 6 months, is to just solve this financing problem for our clients. And we've got four really solid solutions, and that 4.75% solution, honestly being one of the best.
Yeah. I think a lot of people who are non-financial folks really don't understand that money is a commodity like anything else, and it has a price, which is the interest rate. The Fed has been making money more expensive, and in order to get it cheaper, you have to purchase in bulk. And of course, to be a bulk purchaser of money, you have to be able to turn that inventory quickly, or you end up, with carrying too much inventory, and that's just all cost. So I used to be in the distribution business, and that's what we do. We'd go buy pallets of goods like Costco does, and then sell it one at a time to a lot of people, and we'd make a little bit of money on each one of those inventory turns. You can do the same thing with money. In your case, it's facilitating the sale of the product, and you can do it millions and millions and millions of dollars at a time because you move lots of inventory. And so this is the advantage. It's one of the reasons we like to talk to you folks, because we feel like it brings our listeners something that they just can't get if they're out there searching on the MLS, or they're just looking for a one-off deal. And the other thing is, when you come in underneath a brand, whether it's our brand or somebody else's, so when you go buy something at Amazon from a one-off seller, if you have, need customer service, they're a lot more concerned about their relationship with Amazon than they are about their relationship with you, but they take care of you because they don't want to sour their relationship with Amazon. I know that that's the way it works with the people that promote their businesses through the real estate guys, because they want to stay in good graces. I'm happy to say that the last time we did our little sponsor lunch, or our provider lunch, we call it, at the Secrets of Successful Syndication, I think Southern Impression Homes had the highest listener satisfaction rating. We poll people after they've done business, and you guys are right up at the top of the list. So on behalf of Robert, myself, and all of our listening audience, thank you for doing such a great job for folks, and being innovative and finding solutions instead of just rolling over and saying, "Oh, we're going to wait till it's easy." We're going to show people how to get into the market in a kind of a contrarian way, and take advantage of the opportunities, window of opportunities, which you guys have explained why it's here, and it may not last forever, but it's here right now. Jim, is there anything else you think folks need to hear about, maybe some common questions you deal with, or some secrets that you have as far as how you get deals done in the market you're in, whether it's financing or anything else?
Well, I think research is just an important thing, Russ. And coming from working with people all over the country, you hear assumptions, and then you have to test the assumption in your own backyard. I can't speak for the national weather average, but I can speak for, the Florida averages in our markets. And a lot of people were saying to Chris and I, the markets are tapped out. The markets are tapped out. It's too high. And so I always look at that. What excites me about Florida is we're always looking at our median value in our markets and the average family household income. And that's a big marker for us to see if we're still in a healthy relationship for cash flow on our properties. And we had a lot of people coming out of the West Coast that were bringing this assumption. They had been investing, we'll just say, in Salt Lake and Boise, Idaho, coming out of California, two solid fundamental markets. But man, did they go up through the pandemic. Well, the median household income for those two markets is about $60,000 in each of those markets. And that's the average for like our Jacksonville and Cape Coral market as well. But when we looked at the median pricing in those two markets, it was about $250,000 higher in both Boise, Idaho, and Salt Lake compared to Jacksonville and Cape Coral. So when people are saying and testing these assumptions, they're going, the market's tapped out. And we're going, no, it's not. And then we're like, oh, wait, which market are you talking about? So having that deeper conversation, we're always trying to research what's happening in other markets in the country and how does ours compare, especially when it comes to median values and also family household income. That's just a big study guide that Chris and I follow.
Yeah, this is such an important point because we make this point all the time. Real estate is not national. And so what is tapped out in one market is cheap in another market. And when people are moving from a higher price market to get relief from being tapped out in that market, when they come into a more affordable market, they think they've died and gone to heaven, and they readily bid prices up in order to gain access to limited inventory and in the best places. In the act of doing that, what they do is they take the indigenous people, if you will, the incumbents, and they push them out. And in some cases, people who were former homeowners now become renters, and people who are renters in a more expensive market move to a more affordable submarket within the major metro. We've seen that happen. People get pushed out of Orlando and they end up in places like Jacksonville because they're still close to home, they're still close to work, they're still close to everything that they love, but they've been able to find a way to maintain a standard of living, even though the personal purchasing power has gone down because of real estate inflation. So, we could go down a whole rabbit trail on that, but you guys have been kind enough to do, as you always do for us. We ask that all of our boots on the ground teams put together and maintain an updated market report that just talks about the high notes of what's going on in the market and an invitation to get on your mailing list and keep updated. And so you guys have put that together for us. So if you're watching this and you're interested in putting your thumb on the pulse of the Jacksonville and greater Florida market through the folks at Southern Impression Homes, just send an email to Jacksonville@realestateguysradio.com. Jacksonville@realestateguysradio.com. You'll get the report right away. You'll get any updates that are made to the report, and you'll get the occasional news alerts or whatever it is that they have as things are changing in the market, because the markets are dynamic. And of course, we always say you start with your investment philosophy. What is it you're trying to accomplish? I think anybody investing in real estate is interested in long-term equity growth, long-term growth of cash flow, tax breaks, a hedge against inflation, an opportunity to use debt productively, all the things we love about real estate. And then you marry that to a geographic market. In this case, it would be Florida, and an investment product type, in this case, residential housing. I think that's got a pretty good track record. And from there, you look at a team. You pick a team that you can bet on, somebody that's going to deliver you a good investment property and be there to help you manage it after the fact. And the thing that I love about Southern Impression Homes and Suncoast Property Management is the two firms work together to provide that for anybody who's interested. I love the fact, Jim, that you're here and you're involved in investor education and you're that investor liaison. We think education precedes action. That's why we do these shows. Robert and I don't have any real estate to sell. We just like to see people get involved in it. So, guys, I really appreciate your time today and sharing your expertise. Jim, it's nice to get a chance to finally meet you face to face. I've heard good things about you, excited about the direction, Chris, that you're taking Southern Impression Homes. And we're working on trying to get a field trip back on the calendar. Our Robert and I, our schedules got eaten up this year, so we're not sure we're going to be able to pull it off, but we're working on it. So whether you do it with Robert and I in tow, or you find a way to get out there on your own, folks, I encourage you, go out and take a look at Jacksonville, visit the folks at Southern Impression Homes, and check it out. If residential real estate is part of what you want in your portfolio, they're probably a team in a market you want to give consideration to. So order the special report, Jacksonville, at realestateguysradio.com. Watch for the updates, and we'll see you on the Real Estate Guys Radio Show. Thanks so much.
Good to see you, sir.
Thank you.
Thanks, guys.